Ladies and gentlemen, listen carefully, because what I'm about to explain is not noise, not hype, and not a rumor drifting through financial social media. This is about positioning pressure and a moment in the silver market that many said could never happen. They got caught. A $6 billion silver short built quietly, defended aggressively, has just collapsed. And when shorts collapse, markets don't whisper, they reprice. For years, silver has been treated as the afterthought of the metals market. Gold got the headlines, stocks got the attention, and silver was told to stay in its lane. But beneath the surface, something very different was happening. Large players were leaning heavily on the short side, betting, with enormous size, that silver prices could be controlled, capped, and pushed lower whenever necessary. That bet grew, and it grew dangerously large. Here's the first hook most people miss: shorts only work when liquidity is abundant and confidence is unshaken. But liquidity is drying up. Physical silver inventories have been tightening, industrial demand has been accelerating, and delivery stress has been quietly building. When you short a market that's losing supply, you're not making a trade, you're making a promise. And promises must eventually be paid. Now let me be very clear. This $6 billion short didn't vanish overnight because of one headline or one bad trade. It collapsed because margin pressure met reality. Prices moved higher. Volatility expanded, and suddenly those short positions required more collateral, more cash, and more faith than the system could provide. And faith is the first thing to disappear when losses compound. Here's the second hook: when shorts are forced to cover, they don't cover politely. They buy back into strength. They chase price. And every dollar silver moves higher increases the pain. What looked like smart money control quickly turned into a feedback loop of forced buying. This is how suppressed markets snap. Not gradually, but violently. This is bigger than silver alone. It's a signal. A signal that leverage is no longer cheap, that manipulation through size has limits, and that real assets are beginning to reassert their value in a world drowning in debt. When a $6 billion short fails, it exposes fragility, not just in one trade, but in the entire structure that supported it. Ask yourself this: if silver can no longer be easily capped, what does that say about inflation expectations, currency credibility, and trust in financial engineering? Silver isn't just a metal, it's an industrial necessity, a monetary shadow, and a pressure gauge. And right now, that gauge is flashing warning lights. The final hook is this: most people will only notice after the move. They'll call it obvious in hindsight. They'll say the signs were everywhere. But moments like this reward those who understand positioning, not headlines. This wasn't luck. This was math, supply, and leverage colliding at the same time. Nundujivme 6KY Puyansa economics TYE. The $6 billion silver short was not merely a large trade. It was a concentration of leverage that quietly evolved into a systemic vulnerability. When a single directional position grows to that scale, it stops behaving like a speculative bet and starts functioning like a structural dependency within the market. Price stability becomes reliant on the assumption that conditions will remain favorable indefinitely. That assumption, in economics, is where risk hides. Because markets do not reward permanence, they punish imbalance. What made this position especially dangerous was not just its size, but the environment in which it existed. Liquidity was thinning, financing costs were rising, and volatility had begun to re-enter the silver market after a prolonged period of suppression. In such conditions, leverage becomes brittle. Every incremental move higher in price increases margin requirements, forcing the short holder to post additional capital simply to remain in the trade. At that point, the question is no longer about being right on fundamentals. It becomes a race against cash flow. Here is the hook most observers miss: short positions have theoretically unlimited risk. Gains are capped, but losses expand exponentially as prices rise. When a short reaches billions in notional exposure, even modest price movements can translate into massive mark-to-market losses. The trade no longer responds to strategy, it responds to arithmetic. And arithmetic, unlike sentiment, does not negotiate. As prices began to lift, the position faced a cascading problem. Higher volatility triggered higher margin thresholds, which forced capital to be diverted from other uses. That diversion weakens balance sheets, reduces optionality, and limits the ability to defend the position further. In economic terms, the trade crossed the line from efficient leverage into capital inefficiency. Once that line is crossed, time works against the position, not in its favor. Another critical factor was concentration risk. When a limited number of entities control an outsized share of short exposure, the market's resilience diminishes. Any forced action, whether from risk managers, clearinghouses, or counterparties, has an amplified effect. Covering is no longer gradual, it becomes abrupt, and abrupt moves create feedback loops that accelerate price discovery in the opposite direction. This is where the trap closed. The short position required stability to survive, but its very existence undermined that stability. As confidence eroded, defensive buying replaced strategic positioning. What began as a controlled bet transformed into a liability that threatened broader exposure. In the end, the collapse was not caused by emotion or speculation. It was caused by scale. When leverage grows faster than liquidity, the outcome is not uncertainty. It is inevitability. The failure of paper-based price control in the silver market began with a simple imbalance that could no longer be ignored. Physical supply was tightening while synthetic supply continued to expand. Futures contracts, swaps, and unallocated positions created the illusion of abundance. But illusions collapse the moment delivery matters. This is the hook most markets overlook. Paper liquidity can multiply instantly, but physical metal cannot. When demand shifts from price exposure to possession, the rules change. Industrial demand for silver has been accelerating across energy, electronics, and defense-related applications, locking in long-term consumption that does not respond to short-term price signals. Unlike speculative demand, industrial usage is non-negotiable. Manufacturers cannot hedge away physical necessity. As more silver was committed to fabrication, less remained available to satisfy delivery requirements in the futures market. That shrinking pool quietly raised the cost of maintaining large short positions, even before prices visibly moved. At the same time, above-ground inventories were declining. Vault stocks that once provided confidence to paper sellers began to thin, and inventory turnover increased. This is where the structure weakened. Paper markets rely on the assumption that physical settlement will be minimal. But when participants start questioning availability, confidence erodes rapidly. The moment market actors begin asking, can this metal actually be delivered? The leverage embedded in derivatives becomes a liability. Here is the second hook. Price suppression only works when physical holders are willing sellers. When supply tightens, physical holders gain pricing power, not paper traders. The futures market can signal prices, but it cannot manufacture metal. As spreads widened and delivery premiums emerged, the disconnect between paper pricing and physical reality became harder to ignore. This disconnect acts like stress in a fault line, unseen until it releases. Short sellers found themselves trapped between two forces. On one side, rising industrial demand and shrinking inventories reduced available supply. On the other, growing awareness of that scarcity increased the likelihood that contracts would be challenged for delivery. This forced shorts to either roll positions at increasing cost or reduce exposure entirely. Neither option preserved control. The deeper issue was structural. The paper-silver market had expanded far beyond the size of the physical market it referenced. That imbalance works only as long as confidence remains absolute. Once physical constraints surface, even subtly, the leverage embedded in paper instruments begins to unwind, not because of panic, but because of logistics. What ultimately undermined paper dominance was not a single event, but an accumulation of pressure points. Every ounce committed to industry was an ounce removed from flexibility. Every decline in inventory reduced optionality, and every question about delivery weakened the foundation supporting artificial price stability. When physical supply tightens, paper control does not bend, it breaks. Volatility is the silent enforcer of financial markets, and when it returns after a period of suppression, it does not arrive gently. In the silver market, rising volatility acted as the catalyst that transformed a stressed short position into an unsustainable one. This is the hook most participants underestimate. Volatility is not just price movement, it is a direct tax on leverage. The moment volatility expands, the cost of holding risk increases automatically, regardless of conviction. As silver prices began to move higher, daily price ranges widened and intraday swings became more pronounced. Clearinghouses and exchanges respond to this mechanically by increasing margin requirements. This is not discretionary and it is not negotiable. Higher volatility means higher perceived risk, and higher perceived risk demands more collateral. For large short positions, this translates into an immediate and escalating demand for cash or liquid assets, simply to remain open. Here is where the pressure compounds. Margin is not a one-time expense, it is a dynamic obligation. Each upward move in price, each spike in volatility, triggers recalculations that drain capital. Even if the underlying thesis remains intact, the ability to maintain the position becomes constrained by liquidity, not logic. This is the point where trades stop being expressions of belief and start becoming endurance tests. The second hook is this margin calls rarely arrive alone. When volatility rises across markets, capital is stressed everywhere simultaneously. Funds and institutions are forced to prioritize. Capital allocated to defending a losing short in silver is capital unavailable for other strategies, other markets, or risk buffers. This creates internal pressure that often forces risk managers to act before markets do. As collateral demands increased, the short position entered a reflexive loop. Rising prices increased volatility, volatility increased margin requirements, and higher margin requirements forced partial covering. That covering, in turn, pushed prices higher still. What appears externally as momentum is internally experienced as compulsion. At that stage, the market is no longer responding to information. It is responding to constraints. Another overlooked dynamic is reputational and counterparty risk. When volatility spikes, counterparties become less tolerant of exposure, and credit terms tighten. Haircuts increase, financing becomes more expensive, and optionality disappears. The short position is no longer judged solely on potential profit, but on the risk it imposes on the broader balance sheet. The defining feature of this phase was inevitability. Rising volatility removed the ability to wait. Time, which normally benefits large, patient positions, turned hostile. Each day the trade remained open carried a higher cost than the day before. In economics, this is the moment when markets assert discipline. Not through opinion, not through narrative, but through margin. Once short covering begins, the character of a market changes instantly. What was previously a landscape of sellers becomes a battlefield of urgency, where the primary source of demand is no longer optimism but necessity. This is the hook that catches most observers off guard. Short covering is not discretionary buying. It is mandatory participation. And mandatory participation has no price sensitivity. In the case of silver, the initial covering may have appeared orderly, but beneath the surface it was anything but. As prices moved higher and margin pressure intensified, short sellers were forced to reduce exposure incrementally. Each buy order placed to cover a short position removed supply from the market and added demand at the same time. This dual effect is what makes short covering uniquely powerful as a price driver. It compresses liquidity while accelerating momentum. The second hook lies in the psychology of defense. Short sellers do not cover because they believe in higher prices. They cover because the cost of remaining short becomes greater than the cost of exit. This creates a highly inelastic form of demand. When prices rise, long buyers may hesitate, but short sellers cannot. Their buying increases precisely when prices move against them, creating a feedback loop that reinforces the trend. As covering accelerates, market depth thins. Limit orders are consumed more quickly, spreads widen, and price gaps emerge. What might normally be a $1 move in silver becomes $3 or $4 in a compressed time frame. This is not speculation, it is structural imbalance. The market is being driven by forced behavior rather than voluntary positioning. Another critical dynamic is signaling. Rising prices caused by short covering send a powerful message to other participants. Something is wrong on the supply side. This attracts momentum traders, algorithmic systems, and institutional allocators who respond to price action rather than fundamentals. Their participation adds a secondary layer of demand on top of the primary covering flow, intensifying the move further. The feedback loop becomes self-reinforcing. Higher prices force more covering. More covering pushes prices higher. At this stage, even small remaining short positions can have outsized impact because liquidity has already been depleted. The market no longer needs new information to move. It only needs remaining shorts to blink. This is where control is lost. Attempts to re-establish shorts at higher levels often fail because volatility and margin requirements remain elevated. What was once a controlled trade transforms into a disorderly unwind. The market does not wait for consensus or confirmation. It moves until the imbalance is resolved. The defining feature of this phase is speed. Short covering collapses time horizons. Decisions that were meant to be executed over weeks are forced into hours or days. In economics, this is how suppressed markets reset, not gradually, but through bursts of compulsory demand that leave lasting repricing in their wake. The collapse of a heavily leveraged silver short exposed a broader truth about modern markets, leverage is only powerful when liquidity is cheap and abundant. When financial conditions tighten, leverage stops amplifying returns and begins amplifying fragility. This is the hook many institutions learn too late. Leverage does not break gradually, it fails suddenly when the margin for error disappears. For years, high leverage strategies thrived in an environment defined by low interest rates, predictable volatility, and generous financing terms. In such conditions, carrying large positions was efficient, even encouraged. Risk models assumed stability, correlations were compressed, and drawdowns were treated as temporary inconveniences. But when funding costs rise and liquidity thins, those same strategies become structurally unstable. In the silver market, leverage magnified exposure far beyond the capacity of available physical supply and near-term liquidity. What appeared manageable under normal conditions became unmanageable once volatility and margin requirements increased simultaneously. This is where leverage reveals its true nature, not as a tool of control, but as a multiplier of constraint. Every dollar of adverse movement demanded multiple dollars of additional capital, reducing flexibility at precisely the moment it was most needed. The second hook is balance sheet realism. Leverage positions do not exist in isolation. They compete for capital with every other obligation on an institution's books. As stress builds, capital must be reallocated defensively. Positions that consume excessive margin relative to expected return are no longer strategic, they become liabilities. In that environment, even trades with long-term merit are sacrificed for short-term survival. Another critical exposure was model risk. Many leverage-based strategies rely on historical volatility and correlation assumptions that break down during regime shifts. When volatility re-enters the market after a prolonged absence, risk metrics lag reality. By the time models adjust, losses have already accelerated. This creates a dangerous gap between perceived risk and actual risk, leaving institutions exposed during the most unstable phase. As leverage limits were breached, confidence deteriorated, not just externally, but internally. Risk committees, counterparties, and clearing members began to reassess exposure. Financing terms tightened. Haircuts increased and optionality vanished. What was once a profitable structure became rigid, incapable of adapting to fast-moving conditions. The deeper implication is systemic. When leverage dominates market structure, price discovery becomes distorted. Moves are delayed, then exaggerated. Stability gives way to sudden repricing, not because fundamentals changed overnight, but because leverage reached its limit. In economics, this is how fragility reveals itself, not through small warnings, but through abrupt failures that force markets back toward equilibrium. Silver's sudden reassertion was not an isolated commodity event. It functioned as a signal embedded within the broader monetary system. Markets often reveal stress at the margins first, and silver, straddling the line between industrial necessity and monetary asset, occupies that margin uniquely well. This is the hook most investors miss. Silver does not move loudly at first. It moves informatively. When silver begins to reprice, it is rarely about speculation alone. It is about confidence. On the monetary side, silver has long acted as a shadow indicator of currency credibility. Unlike fiat instruments, it carries no counterparty risk and no promise attached to future policy decisions. When inflation expectations rise or confidence in monetary discipline weakens, silver quietly absorbs that tension. The recent move suggests that markets are beginning to question the durability of purchasing power, not in theory, but in real time. This is not panic, it is recalibration. At the same time, silver's industrial role grounds it in physical reality. Demand from energy transition technologies, electronics, and advanced manufacturing creates a base layer of consumption that is largely insensitive to short-term price fluctuations. This dual demand structure gives silver a signaling power few assets possess. When prices rise alongside tightening supply, it reflects both monetary unease and tangible scarcity. That convergence is rare and meaningful. The second hook lies in what silver reveals about real asset pricing more broadly. For years, financial markets have favored abstractions, derivatives, digital exposure, and leveraged instruments over tangible inputs. Silver's repricing challenges that preference. It suggests that markets are beginning to differentiate between assets that can be created by policy and assets that must be mined, refined, and delivered. That distinction matters when balance sheets expand faster than productive capacity. Silver also functions as an early warning system for inflation transmission. Unlike consumer price indices, which lag reality, Silver responds to shifts in expectations and capital flows ahead of official data. Its movement reflects how market participants are positioning for future conditions rather than reacting to past ones. When silver strengthens decisively, it implies that inflation risk is no longer theoretical, it is being priced. Another overlooked aspect is trust. Financial engineering relies on confidence that systems will function as designed. When stress appears in a market, as small yet essential as silver, it raises broader questions about the resilience of larger, more complex markets. If pricing pressure emerges here, it may foreshadow strain elsewhere. Ultimately, silver's role in this episode extends beyond price. It served as a messenger, carrying information about liquidity, confidence, and the limits of control. Markets speak in signals before they speak in crisis. Silver just spoke. So remember this moment. Remember when a $6 billion silver short didn't just lose, it collapsed. Because markets don't change narratives gently. They change them when pressure becomes unbearable. And today, silver just reminded the world of a simple truth. When you bet against reality for too long, reality always wins. Thank you.